This week, markets gave us a clear signal, but most traders missed it. If you know where to look, next week could be a game changer. From NVIDIA's blowout earnings to the Fed's mixed signals, market dropped plenty of clues, but most traders are focused on the noise. In this video, I'll break down exactly what mattered most on the week, what most traders missed, and how I'm preparing for the week ahead. We have a lot to go over. Let's get to it. Hey everybody, welcome back. Well, ES looks like it didn't go anywhere, but it actually did a lot. To start with, just the basics. Let's just get into it. This is Itchy's FOMC speech when it ended in December. This is when he cut rates, said he didn't know why. It's also the October 24 PPI level. And you can see how we just keep rejecting that area. The July negative CPI month over month from 2024 PCE data was released in the December contract roll. That area, that held immensely. Like, it's crazy how much that actually acted like a magnet. What I see really is an issue with the breadth, and I'm going to describe this and where I see the issues. 27.5% of you that watch these videos do not subscribe. Make sure you click the subscribe, all notifications. What we go over here is not only informational, but I work education into it, and it's timely. Let's get to it. Between the tariffs and NVIDIA's earnings, what smart money, dumb money's doing, the last hour of trading, there's a lot of clues out there, but let's just start with the real basics here. Just the ADL line, the advanced decline line. You're not going any higher, but the market's not going any higher either. So what's this mean? You're stalling. Is that a bad thing? It's a bad thing if the ADL line, and we're going to go through this in one sector in particular that's just absolutely screaming to buy it. But what's so fascinating to me is it's in line. So yeah, we're not really going up, but you're not really going down either. And I think it's really important to get this. Like, it doesn't have to go up all the time. Like, if it was going up and this was going down, we'd have a problem. So you could see in here, in other words, like, it's commensurate with what's happening. And as long as you're commensurate with what's happening, you're fine. It's when it's not commensurate that you want to pay attention to it. And so I don't really have a problem with it. My problem is more in some of this data. Now, when I usually show this breadth indicator, I show it in a different way. I'm showing it differently today on purpose. But what we really want to focus on are a couple things. And it starts with the basics. It just starts with this is the 200-day, this is the 50, and this is the 20. And you can break this out as well by different sectors. And what I mean by that is you could show staples in here, healthcare. We're going to get into a little bit of this in a moment. I really don't like how this is showing this up. What we can do here is just probably click off of, I don't need this on there, do I? No, I've got these all over the place. And again, these videos, when I do them, they're usually pretty unedited. I just rock and roll with it. You can see the 200, the 50, and the 20. And I'm going to keep them all the same color because I think it's the uniform here that I really want you to focus on, as well as you can see what's going up here. But we're going to get rid of this in a sec here. And what I'm going to do is just pull that up. And what I want to do is just focus on what you're saying. So on something like the 200-day, you can see that you're flatlining. And you always want to be above that 50. If you're not above the 50, you really need to be careful of the market. And what it means is that 50% of all stocks in the S&P are now below their 200-day moving average. That's not great. If you look at any great run in the market, any great run at all, like you had from November 23 all the way to what you had till March 2025, you were above. You're not right now. And this is super important to get. When you try to get above it, you got completely matumboed, rejected. That's not ideal. I've seen ideal before. That's not what it looks like. So when we look at this from a long term and you go long, medium, intermediate, that becomes a problem. But when we get into here with the 50, we are above where we need to be. But if the 200 is not moving in the same way, we have a problem. And the 50 can only go so high, usually the mid 80s, and then we'll see some kind of pullback. And we'll try and align these a little bit better so they move, but it is what it is. The important thing about this for me is that if we're here in like the 80s, it's only can go so high. So like there's times when you get to like a 90 and you know you're coming in. You know that it's got to come in because it's just not realistic unless the Fed's injecting, trillions of dollars of capital into the market. We're in line and we're above 50. And institutions do watch the 50 and they want to make sure that you're above the 50. So if we just mark that here, you would go, okay, well, medium term, we're okay. Long term, we're still struggling and maybe we're just going to pop back over it. And that's okay. Here's where the devil's in the details for me. When I get into the 20-day, and I'm at this 53 and I'm hitting lows as I'm going sideways. And I left the 5-day out for a moment, but now I'm going to show you this in some detail. And this is, again, super important. When you look at these together, most people will put these together and create their own breadth indicator and they'll come up with a number and saying we're overbought here or oversold there. No, you need them to be broken apart so you can see what they're actually telling and then look and compare them together. I know it's easier to look at one number and say the market's doing this, but it's the rotation and distribution that you're going to pick up by pulling these numbers apart here. So in front of us is the 20-day moving average, and on top of that is the S&P. Now watch. When we look at the 5-day, and we look at the 20, you're seeing something really clear that you don't really want to see. And again, we have short-term, medium, long-term indicators. I'm going to go through one medium-term indicator in a second here that I like a lot and is giving me like really good signals. This not so much. And so I'm getting some conflicting data. I'm always interested in your opinion, so please comment. But when I see stuff like this, it puts up my antenna, and I'll explain. So the 5 was at a 7% of all stocks. That was it, that were above the 5-day moving average. That's what we were dealing with on Monday. Friday, if you just kind of look from here, by Friday, you were at 52. You went to 69. During that period of time, if you take a look at what really happened here to the market, we didn't really go anywhere on the 20. A matter of fact, what you would say is that we lost more names on the 20. And as we just saw, we lost more names on the 200 and the 50s flatlining. The only way that you can do this is through distribution, meaning the only way that stocks can be breaking below their 20-day moving average and some names are getting above their 5-day moving average is if you're rotating through the names and you're selling. There's no other way for it to happen. So it's that distribution that ties into the AD line that we just went over. Now, what's interesting about this is what institutions are actually doing in the last hour of the day and how that might help us understand where these lines are actually going. Because by looking at each one of these lines individually, it tells us more than just looking at it in aggregate form. So let's get to it. Now, one of the indicators that I use a lot for breadth, and it's a medium-term indicator, and this is super important to get. When you look at an indicator, you have to understand that you have to make a decision on what time frame you're going to use that indicator on. I was reminded of this yesterday when I was talking to somebody that I work with, where they really, if you're looking at an indicator and you're like, oh, this is the short-term indicator, great. If you're thinking it's a long-term indicator and it's a short-term indicator, great. You're going to have issues. There's no way around it. In other words, looking at the RSI on a daily and saying, oh, well, that means on Tuesday we're going to drop is just nonsense. It just means you're heavy. This is a medium-term indicator. And as always, when we do these videos, it's super important for you to understand what the heck you're looking at instead of just drawing a couple lines. Medium-term to me is if you're swing trading, but you're looking out weeks or months. That's medium term to me. If I'm thinking long term, you need to be in something for at least a quarter to consider to be in long term. Update schedule daily. That means it's updated daily. This is by Sediment Trader. I've already spoken to them and they are fine with me showing their content. I have no affiliation with them whatsoever, but they put stuff together and I think it's pretty good. Now, what they do is they calculate out what the last hour is and they do it in a cumulative way. It's so important. If you take one thing from this whole video, when you're looking at something, if you are just looking at a moving average and you don't even understand how that moving average is truly calculated, like I'll say to people, oh, I look at EMAs versus SMAs. And I'll say, well, how are they calculating that? People don't even understand there's ways to calculate different moving averages from open, high, low, close to just the close, just the open. It's super important for you to use not only what you're comfortable with, but what works. So I always go through the construction of these so people understand, hey, this is really what you're looking at and this is how they think there's value in it. So they do it on a cumulative nature. So when you think cumulative, think +1, -1, it builds upon itself. It insists upon itself. All right. The last hour indicator, advanced decline for the last hour of trading SPY ETF. Last hour of trading is up, the value is 1, +1. To advanced decline, cumulative. If down, -1. The trend model applies to moving average to the advanced decline line, looks for instances that the count deviates below or above the moving average. I'm not really interested in the moving average. What I'm interested in, now that I have the data, I can do what I want with it. For me, it's not about the moving average. It's about the areas in which it stops and starts to go cumulative again. That's what's important to me, and I'll explain why. When institutions are selling, you don't want to buy. It's really that simple. Now, why is it that simple? Because retail can't hold themselves up. Retail has no self-control. They just don't. And we know this, but what's really important about this is when institutions are selling, we don't want to be in a position where we're going. One of the key things that I learned in the way that I trade is that institutions They're the sharks. We're the remora. We just grab on their coattails and go where they go. Whether that new thing is the algorithm or whatever they're doing, we just grab. The last hour of trading usually marks what happened on any given day. It just does, because that's when institutions move. You can always see the moves after 2:30. We're not going to spend a lot of time on that, but just go market charts at 2:30 from 3 o'clock and you'll start to see a change in trend, usually almost every single day, where the volume will start to pick up. Fridays are usually when pension funds look at their accounts and go, okay, well, we're supposed to buy or sell X. Now, they don't care where they get out. They know that they have to sell because they have to reduce their exposure. Pension funds work on assumptions. They don't work on percentage and performance. We've gone over this in other videos. I'm not going to do it again. But just understand that. So what I've done here is I've just marked off those Fridays. Now, why Fridays? Because if they're not out during the week, they get out on Fridays. So one of the things that people look at, I'm bringing it home right now. One of the things people look at is Friday closes. So as I learned, which was really years ago on an institutional trading desk, like how they think, if 3 Fridays in a row, if you're down, and it's 3 Fridays in a row, you stay out of the way, because that just means that they're just dumping on the month. You didn't really have that here, but if you mark it off and you start looking like, oh, Friday they dump, you usually have an issue. So you'll see if you look at the S&P, like right here, there's Friday, you couldn't get above that level. Well, why? Duh. Well, besides all our liberation, the real issue was pension funds, that's their level on that Friday where they're selling. So when you go through this and you start looking at those Fridays and you look at the opens and the closes of those, they become key indicators and key levels. Like for example, if you watch on this Friday, you'll see how this is when we got liberated from the liberation. And they said, we're going to pause on the liberation. And then you can kind of see that. And then what happens here? You start seeing the shift, right? Well, what happened on Friday? Well, they started to buy equities on Friday. This is why that last hour that I'm about to get back to is so important. So you come here on Thursday, and then here's Monday. Obviously, you have to use Thursday because that Monday's closed. And then you watch this level. Well, you needed news to pop you over, and then you got it. But what happens after that news on a Friday? You're up. Then what happens again on Friday? Same level. See how this works? Fridays are the single most important day. Green are the single most important day. The most important thing to me about a Friday is, are we up over the open? Because if you're not up over the open and people are like, oh, it's the options market. Yeah, it's the options market, but the option market is controlled by the entire pension fund industry. If you think the option market is controlled by, people on Twitter, you're delusional. It's the pension funds like CalPERS that are literally moving hundreds of billions of dollars around. You need to understand why what we're looking at is so important. And you might want to just remember that you want to watch how you close on a Friday. You can literally see the shift here. One of the things that's really cool about this shift, why I'm on it, is when you see it, you can't unsee it. It's like one of those things. But now you'll just know going into a Friday, like, hey, are we over the close or not? And if we are, then we're probably okay. Unless, we get mean tweets or something. But all right, let's get back to it. So now you can see why I look at the last hour, why this is cumulative, and you can see why people would look at this. Again, this is not mine, it's Sentiment Traders. And I always just think it's important for me to point that out, and I have no affiliation with them. There's no link or anything like that. What I like looking at is not the areas in which you're peaking and then dropping, but there is a delay to this. And I'm not looking for this to tell me what to do, and I want to be really clear about that. I'm looking for this to tell me where the accumulation is starting, where it's starting to turn on a cumulative level. So I'm way more interested in this, where I have some kind of battle going on, which is what we have going on right now, versus, oh, look, they're just buying and buying and buying. I can look at that. Anyone can get that. I can look at the double top here and say, hey, that's probably, this might be an issue here, because I'm starting to come in here, we're starting to come in here, and then they're dumping on that last hour every single day. I'm getting more -1s than +1s. And this, to me, yeah, can you say, yeah, that'll lead because it's a medium-term indicator? Yeah, maybe you could make that argument, but I don't like using it that way, and there's a bunch of reasons why that I'm not going to get into. What I want to understand is the market being accumulated by institutions at a level, or is it not? So for example, throughout this whole move, we were not, and now you are. So in this scenario right here, you have 05, 06, which was what people would consider a super boring scenario. And you can see this consolidation from 2005, 2006. And if we just kind of come up here and eyeball it, and you look at that little area right in here, God, that's drawn awfully, but this is what you get. There we go. And you'll start to see that accumulation. Then it starts taking off. And then the market's dropping. But as the market's dropping, institutions are like, whatever, boomers, keep selling, we're going to buy. And then what happens? The market just catches and lifts. That's why looking at this and the cumulative nature of it is so important. Whereas here, you're seeing this drop over and over again. And what starts to happen is you just get this lull in here where the market doesn't go anywhere. It's not something like, oh, the sky's going to fall, but it's, hey, are we under accumulation or are we not? Here, you're clearly under accumulation. And then when you break out of that accumulation, well, that to me is what's super important. But you can't expect it to move right away. In other words, like here, if I'm here and I break out of the accumulation, which happens here, when do you really get your move? You don't get your move for months. You really don't get that follow-up move. Let's draw that straight. You don't really get your follow-up move for about 5-6 months. And why is that? Because institutions, as we know from previous videos, when we're looking at the support and resistance areas, and when we go back and look at smart money, dumb money, we know they're in no hurry. They just accumulate. That's what they do. And what I like to do, again, is understand the time frame. Please get that. But if I have this area like here, and you're going, oh, you know what? They're not selling anywhere near as much as they were selling back here in April. And you're like, well, that's pretty obvious. Thanks, Rocky. The pop up, the drop, you never dropped lower. And remember, this is cumulative. So what it's telling us is every day since April, they are buying more and more in the last hour of the market. So if we're just looking at it from just that standpoint alone, you already know that you're being accumulated from here over. And this is important because we look at the breadth indicators like we do, and then we'll look at those and go, well, the breadth is weak. Well, that's fine. And that might mean that we chop around. But underneath that choppiness, they're buying the market. So in the last hour here, and this is 1993 to 1994, and what we can see is super clear here. We can see how you're falling right in line, and then all of a sudden you break out, and then the market doesn't go anywhere. And then about 6 to 8 months later, it just starts lifting. And then after that, you get the next leg. And you can see the next leg here. But if you're looking here at this area, and then you're watching this break, the reason that this break is so powerful is because they're literally stair-stepping you up over time. So people will be like, oh, well, it's this that's correlated. If this didn't happen and the cumulative nature of the market was going on, then this is never going to lift that high. They're out there buying the market. And then as they accumulate that buying, it starts to insist upon itself. So I think that's a really important concept to get. And I wanted to share it with you. And then how would you utilize this for now? You would understand that it just simply means that we're going through periods of accumulation. This is 2013, 14, and you can see it again. And then the market just grinds higher. And then of course you can start seeing the drop of accumulation right here. And then what starts happening? Market starts dropping off or just going sideways and getting choppy. Really important concept. Last week we talked about nuclear energy, the ETF, and some of those other ETFs as well. And obviously they had a really good week. If we just mark it off and just do it super simple, just click from there from the low, and this is where we close at 7.8% on the ETF on the week. Not a bad week, better than a kick in the shins. Probably one of the best sectors of the week, candidly. You're running into an issue here. There's another sector that I read this report on, and I just found it so fascinating. It's not like a sector that I play at all, but I just found the report pretty fascinating. But I always think it's important to go back and look at how this stuff's playing out. I think this is a super long-term theme. I would be focused on the names that actually have some kind of earnings and revenue, not the ones that are selling dreams. And I'm not saying the dream sellers aren't going to work, but some of this stuff like CCJ, if this can pull back and you have these huge cups and they start forming handles, man, a lot of this stuff can really rip. I thought it also was super fascinating, like LEU. One of the guys in the room's been all over me to buy this thing forever. You have real earnings here, but look at how you held your support level right in here and then you ripped. So some of these names look really strong. I'm not going to waste a lot of time going through them. I want to go through some other charts later in this video so that you're prepped for next week, because there's going to be some huge movers next week, clearly. But go through, if you go back to last Saturday's video or you just look at some of these nuclear names on your own, some of them really look like they're setting up and others are just kind of really coming in. They took advantage of this and they did a secondary, and that's why the stock's acting like a pig. I mean, there's really no other reason for it. And I don't blame them. I mean, they don't make any money. Like, that's the thing where I'm saying you want to do your due diligence. As always, when we do these videos, it's information education. It's not financial advice, duh. But when you look at something like this and we get to the stool and you start looking at the way that we view the world, and I haven't drawn the stool for a while. I'm sure you guys missed it, so you're welcome. But here's the macro, the fundamental, and the technicals, and that's how we look at the market. And what's so important about this is what's really driving nuclear right now is not so much the fundamentals. There's no revenues. There's nothing here. We're supposed to earn $300,000. Oh, okay. We earned zero. We earned zero. So people say to me, well, what do you think about NNE valued here? I'm like, they don't earn any money. The idea that you're going to rationalize why this is between 15 to 50 makes zero sense. So all you can rely on is not the fundamentals. You have to rely on the macro. What is this current administration going to do with nuclear energy? A lot. What's the world going to do with nuclear energy? A lot. If you go and read it, we went through it last Saturday, but go read what the Dutch are doing and Germany's doing and France is doing. Like nuclear energy is becoming, quote, clean again. And we saw that with CEG. But what do you do with these names? The only thing you really have is what is the world going to do on the macro front with it? And the other thing that you have is the technical front, meaning do the charts look decent or not? To me, I think that you would focus on the names that have earnings, have revenue, because then that allows the stool to have more stabilization. That's just how I look at it. You should do what you're comfortable with. Let's get to the next sector. I was just surprised, as everyone else is going to be, that this is the sector that I'm actually looking at. But when I read this study, I couldn't get over it. I just find stuff like this super compelling, and I'll explain what I mean by that. So when you have historic drawdowns, you have to look at that and then say, okay, well, why do I care about this? So they went back over 100 years, and you can go back to here to 28, 38. And whenever you have these kinds of drawdowns where you're at that 35% level, this whole sector seems to be in a buy area, and it doesn't happen often. Now, the problem with it not happening often, that's an issue. And the reason it's an issue is because to be of any statistical significance, you need 30 data points. Anyone that's into, anybody that knows anything about statistics knows that you want at least 30 data points. And you want more, the more variables you have, right? But I don't have that. And so this is what I have. So I have to take what I have. But again, you can all see this 35% line. And I think this is super important to go through because people are going to start seeing, I think, some kind of bounce in some of these names. Not all of them. Some of them are going to be absolute pigs and blow up, in my opinion. But let's get into this. Now, out of these 7 data points, you can see 33, 33, 36, 1990, 1955, 77, etc. What I found super interesting about this study when I read it was the following. One, the returns were absolutely insane for 12 months on healthcare. I don't really see it in this area. Like in 33, we could have like this anomaly. But again, I only have 7 data points. Where I think it gets really interesting is 12 months. Like those returns for healthcare are absolutely insane. If you look at the average return for the healthcare sector, it's a lot. The other thing that I thought was really important about this study is the Z-score. And for those that don't know, a Z-score is your standard deviation. And very, very quickly, and they show it here, plus or minus 2, but what you're really looking for is anything over 2. Anything that's over 2 is good because 1 is about a 67% chance, and you're like, okay, I'm going to be in that range. Anything that's like a 2 or greater, if you think a Z-score as standard deviation, just to make it super simple, you're looking at 95%. That means there's that 5% that it doesn't kind of happen if you think about standard deviation in that way. Obviously, it's more than that, but if you just think about it that way, it shows that there's statistical significance. That's what you're looking for. Is there statistical significance in what they're showing? Yes. Do we want a bigger data set? Yes. I don't have a bigger data set. This is what I have. So we have to go with what I have. I think it's pretty fascinating when I look at this and I see the returns after that drawdown. But I needed impetus. And some of the other graphs I'm about to show you do show some change in the trend. It's kind of funny because it's not really my kind of trade, but it's so interesting. It's so bad. It becomes so bad, it's got to be good. So there's this theory that we used to do, and people still do it, but it's like the perp walk. Like the day that they brought Zuckerberg in front of court, back when they had all those things with Cambridge Associates and all those problems that they had, the stock was like 150. The day they brought the Boeing CEO in front of there to like yell at him and all the senators and congressmen, look at me, I'm doing a good job for you. That was pretty much the low on Boeing. It gets so bad that it's got to be, it's got to be good. There's some to that until it's WorldCom or Enron, but there's definitely something to that. They call it the perp walk when they bring them in front of Congress. Anyway, when you see something like this where you're going, well, wait a minute, I've got a 50-month moving average fund of flows in the entire healthcare sector, and it's only the second time that it's ever been negative. Like, there's nothing left to puke out. Like, they've done all they're going to do. And what's so cool about this is you look at where you were. So you look at how filled they were on the healthcare side to where they are now. Now, how they're going to cut this healthcare, what the government's going to do, I don't have a clue about any of that. I'm just pointing out this particular graph, and in 25 years, you're back to this level. And this is the level that we were at before. Do we really want to use the pandemic? No. But what I think is super fascinating about this, in using the pandemic level, is we would all have to agree that is this as much of a panic for healthcare as the pandemic, when we really had no idea what was going on? And everyone was worried about the cost, but just sheer panic. I don't know that it's going to be as bad as that, right? We don't know. Let me rephrase that. Do we have more uncertainty here, or do we have more uncertainty now? I guess you could make the argument between Kennedy and the Kennedy administration and the entitlements and everything else that, yeah, maybe we do have more uncertainty now. Maybe you could make that argument. I don't see it that way. I see this as a much more worldwide, global, more uncertain circumstance than this. And we're in the same position. So that in and of itself becomes interesting. But wait, there's more. When we talk about breadth, the biggest thing for breadth, in my opinion, and anybody can create, and I do, I love this stuff, but the advanced decline line is going up on the cumulative, the AD line is going up while XLV is going down. Like, if there's one trade that anyone knows to do, well, there's two. The first one is anytime the VIX is over 40, 45, you just start buying equity, as long as you have a long-term out view. It's a no-brainer. Go look at the chart. The second is if the advanced decline line is going up, if the ADL is going up and the index is going down, you buy stocks. Like, they're like the no-brainer, longer-term kind of trades that you just do. So when you have what we refer to as a positive divergence in something like this, you need to pay attention. Now, that doesn't mean you have to buy the one that is in the most trouble, but it does mean that you probably want to go through those 76 names and take a look at what's going on under the hood. This is also super interesting. If you go back over, I think this was 15 years. Yeah, 15 years. You can see it right here. And what they're mapping out is, hey, how did this work when you started having corporate insider buys? I don't care about sells. People always show these sells, and you have these stupid services that say, oh, look, so-and-so selling stock in NVDA or this. Their entire net worth is wrapped up in a stock. Like, at some point, they're going to want to have some kind of exit liquidity. It's not a big deal. What I think super interesting is there's got to be gems in this. So there's two ways to look at this. One, do you go out and buy the sector? I think the sector weightings has me looking at this going, do I really want to step in front of that train and go, I will stop the water? I'm not going to stop the water. What I would do, and what I think is interesting, is to go through the names themselves. And I guarantee you there are names that are just being dragged down in this because of what's going on in the sector. They're the ones that I would start looking at and seeing who's buying. Specifically, what I would be looking at are the names. I'll just tell you exactly what you can do, and you can look it up for yourself. I would go and see what institutions have positions in some names, and then see if they're adding to those on this dip, which is obviously hitting the entire XLV. But when we go through the top 10, and this is just from State Street Global Advisors, you can go look this up yourself. I look at these names, and there's a couple standouts to me in the top 10 that might be washed out. Like, how much is Eli Lilly really down because of, United Healthcare or Johnson & Johnson and what they're going through with the bankruptcy and what they're trying to do there? I think there's something to that, but I would go through some of these names. I'll go through a couple very quickly. Now, this is not really my kind of trade. I compartmentalize my trades. So in other words, I'll do long-term swing trades, day trades, and I compartmentalize per account. And that's what works for me. You should do what works for you. But when you look at something like Lilly and, no one likes it anymore. Well, why? I mean, like, not for nothing, but why? They're killing it. And, the growth is going to slow. Is it? Probably not. It's going to be in pill form. Everyone's going to take it. It's probably going to be a cash cow forever. They're probably just going to increase the dividend. When you start looking at names like this that have these levels, that hold those levels after, running up for periods of time, people always assume that you're just going to crack. I don't know that you're going to crack on something like this. What I tend to do is go, okay, and I apologize for the voice this morning. It's a little, crackly, but it is what it is. So deal with it. You can see like the RSIs, but like it's acting perfectly. You kind of have a positive divergence here. You're kind of flipping it. I kind of look at that stuff. Do I have to rush into this? Probably not. I probably don't, but if I was an institution, this would probably be the one that people would look at. I'd be focused on which ones they're buying more than anything. This is interesting, but there's some others out there. The UNH story, you just don't know. And I know people are like, oh, well, the insiders are buying stock. Look, I can tell you stories from like, back in the day of like WorldCom, Enron, and like these guys were buying stock in the open market, outright just printing stock in the open market to try to support the thesis. And maybe they're right. Maybe this all goes away. But do I need to be standing in front of that train and just waiting for that next headline? Once this clears out, I would look at something like that. For me, it would be like, okay, what are the ones that are out there that are not related to this? And you're starting to see stuff like this where people are looking at names like Amgen, and you have these levels. And this stock's a monster, by the way. But if you ever just look at this chart, like it's just absolutely insane. Now we get monthly charts too, but this thing's just an absolute monster, just an absolute utter monster that nobody pays attention. You're kind of at that tail end of it, and you're in one of the top 10 XLVs. So you start thinking about it going, well, if they start putting money to work, maybe they start looking at this kind of stuff. You start looking at stuff like the 4-hour RSI and you're like, okay, well, that's actually breaking out in here, isn't it? As the name's not breaking out. But there's others too. I was going through some of these things like ITOS, and I have no idea what this thing does. And I would be real clear about that. But I was just going through names. The amount of insider buying by corporations in names like this is pretty staggering. So in the comments, and I always find this helpful because I do this in the pre-markets when we do the pre-markets. If you have names that are in this space that are these smaller to mid-cap names that you're interested in that are in healthcare, put them in the comments below and I'll try to cover them in future videos because I want to know what they are too. There's a lot of names out there because this really isn't my wheelhouse. I don't do a lot in healthcare. I would stay with the big dogs, but I think the devil's going to be in the details with this. I think they're going to just take some of these names down and that usually presents opportunity to buy. Now let's get to the fun stuff. Now, after hours on Friday, people were pretty much fried after NVDA and tariff on, tariff off all week, and they may have missed this, so we're going to cover it so that you're prepped for Monday. Trump doubles steel tariffs to 50%, slams shoddy Chinese products while celebrating Nippon's $14 billion investment in America. Two things I would take away from this. Number one, he clearly does not care about the International Court of Trade and what they've said. This is not even on his radar. He's just going to find other ways to do the tariffs. And if you annoy him or he thinks that you're cheating on the tariffs that he's already put in place, he's just going to double down, which is exactly what he did here. This is actually good for a subsector of U.S. companies. We're going to get into it. But what he's doing here would be referred to, in my opinion, as protectionism. I'm always interested in your comments on this stuff, this particular stuff. I don't really have a problem with the fact that our military uses steel. I would like it to be made in the country. I don't think that this merger should have gone through. He's polishing it up, but I don't feel that way. I'm really curious what people think about that. You're calling it a partnership, and what you did was you put a huge fence around it and for Japan coming in and putting in $14 billion. And maybe this does create jobs and everything else, and it is really good. But this kind of stuff, it always bothers me. I do think it's important, but I think it should have been left to its own devices. But this is going to benefit a couple companies greatly. 50% tariff, they can no longer get over the fence. My opinion on what he's referring to here is through aluminum, and when China would put hordes and hordes of aluminum in Mexico and then just move it right across, which has always been my issue with tariffs to begin with, because they just open up subsidiaries in Mexico and Canada and then just come across the line. But this is going to be pretty interesting to see what happens here. Pittsburgh will be respected around the world as the steel city again. Anyone after China, pretty hard, I feel, with this line. We don't want America's future built by shoddy steel from Shanghai. We want it built with the strength and pride of Pittsburgh. And obviously he's in Pittsburgh making this speech, but he's really going after China pretty hard here. Now, there are three names that really benefit from this. If you take a look at NUE, and of course, if you have a name and you think that I should be paying attention to it, just drop it in the comments below. It's always helpful for us to look there, and then other people will see it as well. But NUE on this news just absolutely skyrocketed. And you can see that, you're closing at 109 and you're up here at 104. Obviously, you see the profit taking at 8 p.m. because people are scared to hold anything for more than 15 minutes because you just don't know where the next tweet's coming from. Here's what's important about this one, though. There's no way he's taking this back. There's no way you're going to drop that tariff from 25 to 50% back to 25. So, the whole taco theme that's going on right now is like he's going to cave. There's no way that he's going to be able to do this because he's going to lose his base. So the idea of the steel tariff out there coming into China, steel coming in here or aluminum coming in here, I don't see that one withdrawing. Not under his term, at least. I think it'd be really hard for him to withdraw that. But if you look at some of these names like CLF, NUE, they've been completely destroyed and beaten down. And you can see on earnings just how hard it's been for these companies to get anywhere or to even compete. And now what we're saying is we're going to see that whether you call it a level playing field or whether you call it protectionism, whatever you call it, I don't really care. But you have to think about it. There's no way that he's going to be able to go back on that. Not after that, the fanfare and the band and everything else. You can Google it yourself and spend time on it. But even Steel Dynamics, you closed at 123, and then we look at this right in here, and you can just see after hours, you're just exploding. I would think that there's follow through on this. Maybe not immediately, but the earnings here has to go. Their earnings or revenues have to go up. There's just really no other way around it. Now, does X, which is, I don't know how people don't understand that this is just an outright merger. They can call it a partnership all they want. And you can see, what happened here at the end of the day as well with it. Just that's it, 55 and change, whatever the deal is going to get done at is going to get done at. But what they're doing, what percentage is Nippon going to, expand into this market because of it? I don't know. This thing's not going to stay in the same entity, obviously. But that's going to lead us to looking for places to put capital. I think they're going to look at CLF. I think they're going to look at NUE and realize that next quarter's earnings, they're probably going to be pretty decent because people are going to start saying, hey, we need to start getting our steel from these corporations versus other ones. You're welcome to comment on this. I don't see how he can change his mind on this and drop that particular tariff without looking really, really, really bad. And you could argue that maybe he cares, maybe he doesn't, but it's definitely out there and it's certainly important to pay attention to. And I think that those three names, and you guys are welcome to drop other names, are stocks that you definitely want to watch this week. A couple of names I think are worthwhile for us to pay attention to. And then there's two names that I think are going to be the biggest movers that you're definitely going to want to watch. But if we look at something along the lines of Tesla, and we did this about 3 months ago where we referred to this and saying, hey, you kind of have this base that's forming where the RSI is going higher, and that's the magnitude of the move. And people look at it as valuation. I don't really care how you view it. But when we see something like this, it's like, okay, you're basing. And so we were buying it in here like around 240. And we've been talking about this for months, but I thought you'd get to this 325 neckline and then you'd have a tough time. And I see a lot of people out there looking at this thing saying, no, we're definitely going to push. I'll tell you, there's certain things that I bet against and there's certain things that I don't bet against. And it doesn't mean that I'm right or wrong. And I still have a position in this because I have a huge cushion in it at this point. I'm still over $100. You want to watch these divergences here. When you start having the higher high and the lower, you want to watch this. When you're at a neckline, you want to watch this. He got a key. They're bashing him in the New York Times. Whatever. But you want to watch this here. You have had a huge move. You had the event. Does this become a sell the news event or not? I don't know. But you're filling this gap down. And then if you keep rolling, you're going to just want to start watching some of these averages. And I think that's super important. Like the first one that I pay attention to is always peak VWAP. And I don't use VWAP a lot, but there are times when you want to pay attention to it. This is one of those times. You do not want to break that 310 level and then just find the low and drop a VWAP from there and it'll tell you where you're at as well. Really important. Another thing that people can always do to get a good sense of this is drop a volume profile from the peak. And I'll tell you why I use the peak. Because people say, well, why do you use the peak? I personally like using the peak because the peak allows me to determine where the pain points are. I want to know where the most pain is. And you can see right from here, it's almost perfect. I mean, there's your point of control. And then here you are. And so I look at this and go, man, you need to hold that value high area. And I don't believe you are. I believe you've already cracked it. You cracked it. So you might want to take a look at this and be super careful. You don't really have the catalyst. The next one is we're going to watch a bunch of robo-taxis drive around Austin. Is that what's going to happen, or are they going to be remote controlled again? But you just want to watch this. You're back in a trending market. And when you're in a trending market, and I'm trying to pack as much as I possibly can in here, guys, in the shortest amount of time. So some of these concepts, if you're interested, just go watch again. I don't like spending the same time going over the same thing over and over again. But when you're in a trending market, that's when you start looking at lagging indicators because they're supposed to hold in a trending market. And when they don't, you just want to pay attention to that. So I have the 5 right here. And so it's the 3, the 5, and the 8 on a 15. You should use what you're comfortable with. But when I reject it, all right, then I'm over. Then I test it. And I go through it like a hot knife through butter. And then, you have this event that turns into a nightmare. Here's the important part. End of the month, 350. What did they do? Forget these lines for a second because they're on a 1 minute, not a 15. But what did they do? End of the month, market on close. They just puked it. Like, we actually shorted this end of the day. It was the easiest trade. It was so simple. Because all you have to do is watch end of the month and watch what they're doing. End of the quarter, June 30th, that close, so easy. You just watch the 350 level. They can't cheat the 350 bar. It's really hard to because they have so much stock that they have to move. So it's a very simple trade. Anyway, if you watch this, like they went out. You think that's going to change on Monday or Tuesday? Probably not. So this becomes something that we have to look at with, stop looking at it with rose-colored glasses and just really take a hard look at it. But I like using pain points, because that tells me obviously where the pain is. I think we'd be remiss to not go over NVIDIA here. This was a great quarter, and do with it what you will. I love that people still love to hate this name. Like, I love it. We actually scaled into this in April. I'm still in that trade. I would say this about it, and I don't see a lot of people bringing this up, and so we're going to bring it up. That's where we got DeepSeek. So DeepSeek hits. We don't need these chips. We need, a Band-Aid, a rubber band, 5 hamsters, and a taco. And then we can actually do better than NVIDIA chips. Okay, China. So that's me being sarcastic and don't believe any of it. But what happened was you got right back to that level. You rejected again. So that's a pain point for NVIDIA. And we opened right on it, which gave us a perfect short. NVIDIA is the easiest short off the open after earnings. Like, I think there's only once in 8 quarters where it lifted and that was it. But everyone always buys the hype. I do as well, and then I just trade out of it. But because you just look at past history. Past performance is the best thing we have. We need to get through that level. And you start looking at some of this stuff and going, well, you don't really have a divergence, so to speak. And I do use RSI a lot. I don't really have a divergence, but what I do have is I have a level that I keep rejecting. And I was looking for that day 2 pop. What I was looking for and what I got are 2 different things. I didn't get the pop, obviously. I don't like that you broke below the previous close. You didn't close below it, but if you were to get super technical, you broke. A break is a break, but you held it. I'd watch this really closely. We don't want to lose NVIDIA, and this is going to tie us into the next names that I think are super important. What names did they have to buy on that dip when we started hearing about new sanctions and everything else? What names did they have to get in? They had to buy AVGO. They had to. They could not get in AVGO faster. And again, super important concept. This is something that as soon as we saw this flip, and we went through these concepts, that's why I always tell people to subscribe and click all notifications, because they come out at different times, and I go over the timely things that you need to know at that specific time. So it's almost like to me, besides the information, it's almost like a working encyclopedia of what's actionable, what actually works at that time. That's why I even created the channel, because I think it's just such a great platform. Anyway, when you popped over this area, and we already knew that back here that they were saying, hey, we're going to buy 10 billion of our own stock back because our price is ridiculous where it is right now. And you have these overlays like this, where you're seeing these drops, and whether you use RSI or you don't, I don't really care. But you're holding these areas, you flip, you retest, and then it looks like you're not going to go. And I always measure these bars. Like, I want to know where that 50% line is. That's really important to me. I want to make sure that on these bars that we're above it before I get involved. And this, obviously, it worked perfectly. But this was something like we bought at 182. I'm sick of it because I like showing timestamps when I say that we're doing this stuff. So you can actually see that we're actually, just don't focus on the PLTR trade. But the AVGO trade, and you see where we bought it and what the stop was, etc. You can back engineer it if you want. Anyway, if you look at it from this way, and then you see how we're getting up here, we're right back there, but wait, there's more. Watch this. After, we're going to do tariffs, then we're going to do double secret tariffs. Like, everybody's just exhausted. Like, I'm exhausted at this point. I've been doing this 26 years, and I'm like, man, just please stop. You can see how you rallied right back to that core resistance level. Here's the control bar. And then, wham, they double tap you, undercut, and then from here, watch this. And again, I don't care if you believe in RSI or not, but look, there's another divergence. You can just take a screenshot of that. Someone says divergences don't work, RSI doesn't work. Just send that to them. You don't even have to say anything, but I'm sure you saw it. And then you flip over, and then it's on like Donkey Kong until the end of the day. They couldn't get in this fast enough. And there's a huge difference here. And this is why it's so important. When you pull back, if you remember one thing from this video, when you pull back, you want to know who rallies. You don't want to buy the ones that didn't rally. Like, oh, look, my horse isn't winning the race. Let me go put more money on it. No. You want to go put money on the horse that's running, unless you're shorting. AVGO, they had to get into. The other one that they had to get into, couldn't wait to get into, whether for whatever reason. The volume on this thing was insane. Absolutely insane. They need to be in it. They need to be in it now. And you can see how this is going. And it is just up, double tap, and it's on. I actually thought this thing was going to break down. The other day, I had a real nice trade in it. But I actually thought it was going to break down the other day. And just disclosure, I have a fairly large position in it. It's probably actually one of the largest positions I have on right now. For me, looking at that chart, I mean, this doesn't get any clearer with this kind of break on the end of the month and how they had to just pile into it. That's it.